Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to go ahead and analyze the markets and talk about what's going on. First of all, the US dollar index has bounced ever since I anticipated it initially to start bouncing up and start moving higher. I started talking about it at around 78.30. It's gapped up since and has continued to go higher. Engulfing pattern break above those previous areas of resistance and right above that 50-day moving average. So overall, optimistic on the U.S. dollar index, and we could have a nice little cross right above that, right above here on that 20-day, I believe. Man, these lines are very confusing. Let me just turn off one of them to make sure. Yeah. So basically, it gapped right above that, just to make sure. Sorry, I'm probably killing you guys right now. Basically, it basically engulfed right above that 20-day moving average, and if the 20-day moving average crosses right over that 50-day moving average, you could see a much longer-term uptrend inside of the U.S. dollar index. And if that were to happen, the effects on the Dow Jones Industrial Average would be devastating. And here's a quick chart on the U.S. dollar and the Dow Jones Industrial Average. And we need to understand the correlations that kind of drive this whole entire trade. The stronger dollar usually means weakness for the Dow component. Just the way it works, the markets have been trading like that for quite a while now, and every time dollar strength occurs, it implies deflation. Deflation is bad for businesses, therefore stocks should pull back. That's the whole idea. The issue is the dollar index is, again, the dollar index is basically a basket of currencies trading against one another. The only thing that makes a difference is really a stronger dollar might mean cheaper imports, and if that happens again, our own domestic products have to compete with cheaper import prices, and again, that again could be seen as a negative for U.S. companies. So there's two factors that kind of run into one another. A weaker dollar is good because the whole idea behind a weaker dollar is that when you have a weaker dollar, uh, it generally means that our exports are much cheaper when we sell products to competing markets. And when the products come in from those same markets and they try to sell stuff to us domestically, the prices are higher, and that means that the companies that are in the United States benefit when those products and goods and services are already more expensive and that price is already built in due to currency factors. Okay, so we've talked about currency a little too long now, but the whole idea here is a strong dollar is relatively bad for the U.S. economy. It is good for the U.S. pocketbook, but for companies who have to compete against lower imports prices, it starts to become an issue. And that's just the whole idea. And it's because, again, the dollar index is traded against a basket of currencies. Okay, now the E-mini March 2012 future contracts are pulling back, and we're seeing that 20-day moving average starting to pull back, running into it right now. Again, don't be surprised if the 20-day moving average starts to get engulfed on tomorrow's trading session. And again, just to verify it is in fact the 20-day. Just gonna double check it real quick. Yes, it is a 20-day, and if it got engulfed right below that, don't be surprised. And we do have a slow stochastic cresting right below that. Again, oversold, but not oversold enough. Don't be surprised if we have a nice little pullback in the markets. We've had quite a run here, and anybody who's naive enough to say, "Oh, markets can just go higher because there's enough optimism to back the markets," or another CNBC article goes off and says, "Since economic growth is going on lately, the prices of crude oil going up along with it can be seen as an optimistic sign of future recovery." Well, I'll tell you guys one thing. Internationally, or on a broad basis, a vast macro basis, let's call the whole world economy 60 trillion of GDP, okay? When the price of crude oil goes up, it's bad for everyone, okay? And it's not a leading indicator necessarily of future prosperity, because there's a conflict of higher energy prices and perhaps more productivity in all the other corporate sectors. And I'm going to say one major fact. The whole idea here is that oil companies only represent a certain portion of the economy. The vast majority of the economy is not oil companies. Okay, you have utility companies, you have manufacturing companies, we have technology companies, we have biotechnology companies, we have retailers, we have all sorts of companies. And every time the price of crude oil goes up, it's bad for the working class American who has to pay higher prices for crude oil. Therefore, less money goes around to buy those remaining goods and services, and the rest of it has to go towards oil companies. The issue comes into play when crude oil supply comes off the market. When that happens, that means even the oil companies can be seen as having a negative impact because supply destruction starts to come into play, and demand destruction can't make up for that supply destruction. Yeah, people are saying, well, people are going to use crude oil less. Unfortunately, not less enough, and unfortunately, with so much supply destruction going on, uncertainties in the Middle East, that's what's driving crude oil prices to go higher and substantially higher over a short period of time. Prior to all this happening, though, and I'm going to go ahead and put up the crude oil chart since we're talking so much about it, the crude oil chart has been seen going on an upwards trend for quite a while now. I was talking about that low volume float, and we had a rapid surge of volume again, and that's basically because markets are pulling back. They're pulling back their belts again. Remember, a drop in volume, okay, typically means that eventually the markets are about to rally up again. A vast over push and just a monstrous amount of volume means markets are just selling those contracts like crazy. Once the volume drops down again, it means that the markets are ready to push this thing up even higher. And basically, this is the crude oil chart, April. And again, over the long term, I still see crude oil going much higher. I see this trend being an upwards trend and certainly not a downwards trend, not for a while. But again, see, the thing here with crude oil though is it's had a nice little rise. Some of that had to do with the weakening dollar. The other factor that kind of pushed crude oil even higher was because of the fact that the 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 issues in Iran and perhaps the war or perhaps potential war issues that might emerge with Iran. And if you think about it, Iran is a country. It's different from fighting perhaps a group of, let's say, terrorists. Okay, because when you take one country fighting another country, the amount of conflict that goes on between the two is substantial. Takes up a lot of resources, could lead to a lot of damaged infrastructure, oil pipelines, oil production facilities. All of those things are typically targeted in a war because if you destroy their infrastructure, you destroy their means of producing money or generating money, you destroy their economy, then you're going to win the war eventually. And it's been that way with political negotiations. It's how we dealt with North Korea. Um, no more foreign aid for North Korea. Right now, they don't have enough resources to create a nuclear bomb, and therefore, they probably abandoned creating that nuclear bomb. But we'll see if that's even true, half truthful. But the thing here is, if there were to ever be an armed conflict in Iran, the first target will be the oil fields, the oil pipelines, wherever they're developing those nuclear bombs, those will get bombed as well. Every form of production capability will be destroyed, and that will be the main priority. Then they go after the military installments, and then they go after different things, ammunition, caches, but it's always the economic things and things that make money. Those are always attacked first. Farmlands, any type of resource available, those will be attacked. And because of that, people are fearful and perhaps anticipating higher crude oil prices in the future because it could lead to permanent destruction of oil supply internationally. So we'll see what happens. Euro US dollar did pull back from that channel area that I was talking about. Again, I'm just going to go ahead and bring up the lines real quick just to show you guys. And basically, crude oil, the Euro US dollar pulling back did lead to that nice little bounce I was anticipating in the US dollar index. Bounce and pullback in the Euro US dollar. That Euro US dollar pullback also translated into the Euro Japanese yen. And basically, I could see more downside to come at least over the next couple of weeks, if not months. Markets don't perpetually go higher. And, we're not certain how the whole entire European Union will play out. We do know that China's gross domestic product did, well, the Chinese government did revise their forecasts for 8% growth down to 7.5% growth. So 7.5% growth, not looking too good in Asia. Asian stocks did pull back negative 1% overnight. But aside from that, Europe is also having its own set of issues. They are already entering into the negative GDP territory. Not only just Germany, Italy, Spain, Greece, they're all going to lose economic growth, and the main reason is because of austerity. Governments spend less money, they tighten their belts. The issue there comes into play, and basically, less employees working for the government means less consumption. Less consumption means a contraction in GDP. Less money being borrowed, less money being lent. Again, another, I guess, it's a huge issue of stagflation, deflation. Gold has pulled back. Again, I was optimistic on it over the short term. This thing just kind of crushed itself. Not too certain of what's going on right now. It is pushing through the 200-day moving average. Since the US dollar index does trade inverse to the gold market, though, the main idea here is what happened is the huge engulfing pattern in the US dollar index is the main reason behind why that gold market had such a negative move to the downside. Alright? Now, the thing about gold, though, is that you got to watch the US dollar index very carefully, and always remember that the US dollar index does trade inverse to the gold market. The gold market tends to follow the dollar very closely these days, and it's not being traded on the euphoria that it had previously back towards the beginning of 2011, 2011 towards the end of July, where both the gold and silver market eventually crashed, and from that point onwards, the gold market always followed the dollar index. Um, that being said, I am bearish on gold at this point, and the main reason is because I'm anticipating much more strength in the US dollar index, at least over the short term. Midterm, perhaps the next 3-4 years going out. Gold isn't a bad investment idea, but silver, I still question it, the validity of it, not too certain of it. I really think non-cyclical stocks are really where I would prefer being in, especially the ones that are growing gradually with the nice dividend increases, with the nice dividends. Those seem to be better than precious metals right now overall. Moving on. Oh, but before that, silver is pushing below that 200-day moving average. Wouldn't be too surprised if the US dollar index continued higher. The main reason is because the US dollar index is being seen as some sort of safe haven again because China is revising growth lower. Asian stocks are selling off overnight. The US dollar is being bidded into the, it's being bidded up, and let me just go ahead and quickly pull up the US dollar Japanese yen chart. Alright, so the US dollar Japanese yen did pull back a little bit, and basically I was actually thinking that perhaps the US dollar would continue rallying as people would take their Japanese yens and put them into the US dollar, but if you think about it, the fact is that both the Japanese Treasury bond and the US Treasury bond are seen with the same mentality of safety. So it wouldn't surprise me to actually see banks recapitalize and basically pull money from from the U.S., pull it into the Japanese divisions so that they can properly, I guess, capitalize perhaps their Chinese divisions or something like that. So overall, we're seeing a pretty decent pullback in the US dollar to Japanese yen. I guess it's probably selling the news at this point, and we could probably see a nice little pullback. Again, not too certain behind why it wants, but it may just have to do with recapitalizing and protecting whatever it is that they've been making in China, I guess. So they're going to take money from perhaps the U.S. divisions, and that would mean the U.S. dollar is converted into the Japanese yen, and perhaps the Japanese yen is then converted into the Chinese yuan, or just kept in the form of Japanese yens. Alright, so let's move on and let's talk about the volatility index. Volatility index has again been going in fits and starts. It's going to be a while. Maybe if the stock indexes do pull back this week, which I think there's going to be a very significant possibility of that happening, Now, I wouldn't be surprised if the volatility index had a nice little rally going into all of that. And moving on, Amazon. I really want to talk about this chart real quick. Now, if you guys notice, I'm going to go ahead and get rid of those trade triangles real quick, and I'm going to draw in a quick head and shoulder pattern right here. Alright, and this is the epic head and shoulder of all head and shoulders. Very ugly. Notice the bottom shoulders are trending upwards, but the shoulders are trending lower. Okay. The thing is that we're trading at the bottom end of the range, so I wouldn't be surprised if we did in fact break down and break that shoulder right there. All right. Because we're kind of looking at this from a channel standpoint. We're going towards the bottom end of it. We're in a super head and shoulder pattern. If this were to break down, easily 120 for sure. Wouldn't be surprised. And the thing is Amazon is trading at ridiculous valuations, and this is what I mean by stocks that are ridiculously overpriced. High beta plays, high PE ratio plays should be pulled back. You know, this company is trading at the valuation of $100 billion in market cap, but they're not going to generate, the revenue and the net income of a Walmart, or at least half of Walmart, in the next 20 years. They're not going to generate that level of net income. And when we think about tax issues and state tax regulation coming into play, Amazon has its own set of issues, and I wouldn't be surprised if this stock were to sell off and lose a lot of value. So again, head and shoulder play coming in for Amazon, and I could see $100 per share in the next couple months. Yeah. Okay. LinkedIn. LinkedIn again. The issue with LinkedIn and trying to short this stock right now, it is finding some support on that 20-day moving average. Alright, now that 20-day moving average is, again, going to serve as some support. But the issue with LinkedIn and trying to short it, even though it has a ridiculous 1,400 price to earnings ratio, their profit model seems to be working out alright. Their business model seems to be working out fairly well. And the thing is, with LinkedIn being a part of the whole entire IPO craze that's going to come onto the markets, we've had we're looking forward to Facebook's IPO, and because we are and we're anticipating Facebook IPO to be so darn successful, we are going to ride LinkedIn. Now, I was trying to short this stock way back down here at around 65 or something like that. Didn't see the chart pattern I was looking for, so I had to pull back my short, and I didn't lose that much money, thankfully. But I'm looking at LinkedIn, and I'm thinking to myself, is this valuation good? No, not necessarily. It ran into this double topping area right here and pulled back a little bit, but overall, I am leery on this company, but I can't really do anything about it because, again, Facebook's IPO is coming on in a couple more months. Once Facebook is traded, we can compare LinkedIn with Facebook, and probably from there we could think about perhaps the stock pulling back. But right now it's kind of riding on the coattails of Facebook. So overall, avoid trading LinkedIn. It could go either direction, it could go up really high, really fast, or fall down really quick, really fast. So again, I'm avoiding LinkedIn. It's going to be a while before their profit model even justifies their valuation, but we'll see. We'll just watch this company. That does it for me for today. If you guys have any questions, leave a comment right below.